Hello everyone, I'm Kate and welcome to the Adviseable Advantage Property News Update. We continue to ask ourselves whether this current period of uncertainty in the property markets will have long-term impacts or create structural changes to the Australian property market. Well, we should remember that the Australian property market is extraordinarily resilient. When we've experienced similar economic and political shocks to the system, such as recessions, the GFC, September 11th, or the Banking Royal Commission, for example, the Sydney, Melbourne, Brisbane markets, as an example, have experienced really only small dips and recovered relatively quickly. Many commentators who were predicting severe 20 to 30% drops in the property market this year are now largely revising those forecasts. EMP Capital chief economist Shane Oliver was forecasting falls of 20% in the property market, and he has now revised that to falls of perhaps 5 to 10%. Many markets across Australia continue to have low supply, which has prevented property prices from falling significantly. According to CoreLogic, in May, property prices only fell by 0.4% in Sydney and 0.9% in Melbourne compared with April. Property prices actually grew in Brisbane, Adelaide, Canberra and Hobart in that same period. During times of uncertainty, a drop in buyers is typically matched with a decrease in supply, which allows property values to hold firm. Now, that means that any drop in prices is likely to be very minor and short-lived. Property transactions have been continuing as people buy their first home, they upsize, downsize, or look for ways to invest outside of the share market, which of course is perceived as particularly volatile at times like this. Now, one property type that does tend to suffer in more difficult times are those properties predominantly aimed at the investor market. So typically these are the oversupplied apartment developments in locations around the country where supply outpaces demand. In this instance, both the property values and the rental returns will come under great pressure as investor and tenant demand falls. So what if foreign investment from China slows? Well, the Australian property market is far less propped up by Chinese investors than many people think it is. It's just one of those many topics that makes great dramatic headlines in the media. The newspapers love it. And there are plenty of other foreign investors who are just as interested in Australian property. And Chinese real estate investment into Australia was already down by about 50% in the 2018 to 19 year compared with the year prior. That's without making any significant impact to the market. In the same period, Hong Kong real estate investment into Australia tripled, and there were steep increases in investment by Singapore and Japan as well. So in the short term, demand from China has reduced with less Chinese students coming to Australia and Chinese investors not travelling to Australia to research the market as a result of the travel ban. In the short to medium term, we may also see the Chinese government clamp down again on money flowing out of China to bolster the Chinese economy, or perhaps as part of a political move. Australia will be attractive to foreign investors and migrants. Having said all that, with Australia faring much better than many other countries when it comes to managing the COVID-19 pandemic. And with even the most dire economic forecasts predicting a recovery as soon as next year, Australia will be an attractive and very stable economy in which to invest and a secure and safe place to live. Now, most of us think that this is likely to lead to an influx of migrants and foreign investors from all over the world. We can expect growing migration from places like the UK, the US, or South Africa. The recent unrest in Hong Kong is also likely to see people leave the country in droves, with Australia a likely option to relocate. Domain.com.au economist Trent Wiltshire has examined trends within the Australian property market and concludes that there are two likely scenarios to occur by the end of 2020 calendar year. The first being very modest price falls and the second, a slow pickup in property sales. The most likely outlook for property is for prices to fall modestly in some areas, be broadly steady in other areas, and combined with a slow increase in transactions from very weak levels. The key factor supporting prices so far is that few people have been forced to sell their homes due to losing their jobs or having their incomes cut. And this has been enabled, of course, by the government's financial support packages assisting households whose income has fallen, in combination with banks allowing people in financial difficulties to defer mortgage repayments. The Westpac Melbourne Institute Consumer Survey data indicates that while people think it might be a good time to buy, there is no rush because they think that prices may fall a bit further. So this suggests sales volumes will remain sluggish for the next few months. Perth, Adelaide and Canberra are the property markets most likely to rebound fastest, according to Mr. Wiltshire, who noted that prices are likely to grow at a modest pace and sales activity should pick up. Couple this with the fact that there are few or no COVID-19 cases in these cities, investors can rest assured that the local economies should be able to operate fairly normally thus far. Who knows what's going to happen? We expect that it is unlikely that the Australian property market will sustain any long-term falls due to a combination of natural market demand and buoyancy, and also some migration, foreign investment and government intervention. Even if things change significantly on a global scale, such as the decline of China's investment into Australia, we are still likely to see consistent long-term demand for Australian property, both domestically and internationally. In other news, as it stands at the moment in Western Australia, almost all social distancing restrictions will be removed on the 18th of July. The mining sector is strong due to robust demand from China at the moment. Perth's rental market has held up very well, with the rental vacancy rate back to where it was pre-pandemic and well below the level of a year ago. WA's tourism industry is probably the least reliant of all the states on interstate and international visitors, meaning that border closures should have a smaller impact on that economy. Some regional cities such as Wollongong, Newcastle and Bendigo, for example, may also see prices hold up due to interest from people looking to move away from the big cities. Now, obviously, prices may fall in some towns that have a heavy reliance on tourism. This is why we at Adviseable always advocate in buying in areas that have a very diverse economy and many industries, so that when one of those industries is negatively impacted by something, then there are others that stand a better chance of holding the whole local economy up. Cities such as the Gold Coast, for example, could struggle because of their reliance on the tourism market. As we've been saying for some time, some capital cities and other regions will be hit harder by the COVID-19 recession than others. Inner city Sydney and inner city Melbourne will be most at risk of price falls due to having a large proportion of renters and also due to more significant job losses, particularly in hospitality. These inner city areas are also where a large number of international students typically live. But with borders closed and universities teaching online, international student numbers have fallen substantially, as most of us know. Asking rents in inner city Sydney and Melbourne have fallen by about 6% in the June quarter, whereas the outer suburbs have held up reasonably well. Falling rents and rising vacancy rates mean that many investors may sell, which will push down prices, of course. At the moment, while Victoria is bringing their rate of COVID infections under control, the restrictions on the real estate market include auctions and open homes continuing to be limited to just 20 people. CoreLogic's latest property market indicator summary has revealed for the week ending the 28th of June that there were 1,424 homes scheduled for auction this week, returning a preliminary auction clearance rate of 64.5%. Now, this was the highest number of auctions held in the last 9 weeks, demonstrating an ongoing improvement in seller confidence as auction clearance rates hold reasonably firm under higher volumes. We can also report that data collected by the Real Estate Institute of Queensland has shown that regional Queensland led the way for growth in the Sunshine State. Every region has performed better than expected to date and continues to do so. The best performer for annual median house price growth for a second consecutive quarter was Mackay, with a rise of 6.2% up to 360,000. Mackay's housing market has been in recovery for over 5 years now, with its median house price recuperating from significant falls previously. A dynamic resources sector coupled with large infrastructure projects saw a boost in employment opportunities and population growth throughout that year. The momentum gained over the last year or two has certainly continued into the first 3 months of 2020. The REIQ has also noted the Sunshine Coast property market, which has continued to remain one of the prime spots in Australia for investment. Please subscribe to our YouTube channel so that you don't miss out on our area reports, the free webinars we conduct, and also of our further news updates. Leave us a comment below and let me know if you've got any questions or concerns about your property buying. Please check out our website for further details on our services and how our advisors and buyers agents can help you. And I will see you soon. Bye.